We come now to session 10, limited company accounts. The reason why it's limited, of course, is the shareholders who own the company put a certain amount of money in, and if the company goes into liquidation, all they lose is the money they've put in. To some extent, therefore, it's limited. Whereas for some organizations like partnerships and sole traders, as we will see in due course, that limitation is lifted, so it could be unlimited. However, let's have a look at what it says under session 10, limited company accounts. Learning outcomes: when we have completed our chapter, we should be able to prepare a statement of comprehensive income, also known as the income statement. So I might just write that in, IS, income statement. A statement of changes in equity, also known as a statement of changes in equity, or SOCI, like that. And then the statement of financial position, SFP. Obviously, in addition, we have things like the cash flow statement, or strictly known as statement of cash flow these days, but that we'll come to on some other session. Introduction. Many businesses are constituted in the form of limited companies. The owners of limited companies are referred to as shareholders and are often different from the people that run the company. So let's say shareholders are different from people like managers and directors. So let's highlight the word shareholders. Let's highlight the word different. And people who run the company are people like directors and managers. Directors and managers. Right, what else can I say? The shareholders have very little, if any, involvement in the day-to-day running of the business and employ directors, of course, to run it on their behalf. Might underline that, on their behalf. Limited company financial statements have a very strict requirement, requirements which must be followed by all companies, governed, of course, by the Companies Act or any local country legislation, and the International Accounting Standards Board. Okay? The chairman of the International Standards Board is a gentleman called Sir David Tweedy. And the board writes the accounting standards. They are under something called a foundation and so on. And they have certain policing bodies as well, interpretation committees and so on. But the most important body, as far as we're concerned, is this IASB. They are the people who write all these accounting standards. Some standards are known as International Accounting Standards, IASs. And about the year 2000, it changed, and they became International Financial Reporting Standards, IFRSs. But don't worry too much about those things at this stage of your course. When you come up to F7, hopefully you'll see me then, very soon, we'll pick up some more on these things. Now, the other issue, of course, is we're doing F3 at this level. We haven't quite done F4 yet, not usually. And so at F4, of course, the paper is predominantly company law, and in that you'll come across these Companies Act 2006 and that kind of thing. So do be careful that the knowledge base required is a little bit of company law, but the detail of company law, of course, is at a paper above this level, the next level up, F4. ACC expects you to do the papers more or less in number order, so F3 doesn't expect F4 knowledge. But when you're doing F7, for example, with me, then F4 knowledge will be assumed because a bit of company law is needed as you do that financial reporting paper F7. However, we're looking at F3, a much, much easier paper altogether. You should get a very good mark. So here we are. Let's move on to the next page then as we have a look at the company accounting. The format to be followed, stuck to as per the IAS, International Accounting Standard, as I was saying, must be the format we adopt in our studies. The pro forma financial statements for limited companies were given in some earlier session, remember? However, a copy is given for reference. So here we are. The Statement of Financial Position, also known as SFP. You have there non-current assets. Strictly speaking, intangibles should be shown first. So let's move the, I beg your pardon, tangible should be shown first above intangible, and that is the way it's done on the international basis. So not that the examiner will mind very much, but especially if you're doing a computer-based exam, it doesn't matter. But when you, in real life, when you're doing real accounting, of course, it does matter. So let's go for tangible before intangible. Right, what else? Inventory, that's usually closing. Closing inventory. Trade receivables, of course, are customers. Customers. Cash is cash, of course, and then you have your total assets. So all your assets are listed, the non-current first, and then your current. And then you come to your liabilities, equity and liabilities as it's called. Lower down the page, equity and liabilities. There you have your share capital, more about that later. Very important indeed. The examiner tends to play with your knowledge of share capital and really push you to the limits. You must be careful with that. Very important indeed. Then you have your retained earnings, which is just the profits left over from previous years plus this year. Revaluation reserve. There you have some notes, typically another collection of pages of all these figures explained. Don't worry about it for our particular exam. But in real life, of course, those are important. Non-current liabilities are interest-bearing borrowings, things like loans, long-term loans, also known as loan stock, debentures, secured liabilities, etc. All that comes to 100,000 in this company's case. Then you have your current liabilities, trade payables, people like suppliers, like we were doing on control accounts a bit earlier on the course. Trade payables, suppliers, creditors, people like that, credit balances. And so your SFP, the balance sheet balances. Now, what I'd like just for you to understand is how this would work in terms of, the why we lay it out the way we do. You might notice lower down the page there are things like share capital and debentures and trade payables. Now, the most important thing to understand is if a company is in trouble, let's say it's facing liquidation, and these days some companies are in trouble. We've heard of some famous collapses, especially banks and companies like that recently. Very sad for the people involved, of course, but it does happen. So let's say if you're considering who gets paid first, if a company's in trouble, imagine for 1 second there's a liquidator at a desk. Let's say you be the liquidator. You be standing there at a desk, and all of us are queuing up for payment. So the desk there's a yellow line, stand behind the yellow line perhaps. And so the first person who gets paid is a secured debenture. In other words, I loan money to the company. I'm a payable, so I've loaned money to the company needs to pay it back to me, so it's a payable in the company's books. But because I'm secured on, let's say, a building, the security, the building itself, will be mine if the company does not pay me. So obviously the first thing the company does is to pay me off. So the secured debenture gets paid first. The person who gets paid next is the liquidator. The liquidator's expenses. Otherwise, no one will be a liquidator if they're paid last, because by definition, if a company's in trouble, there may not be enough money to go around. So let's go through that again. The liquidator is standing over there. We are all queuing up. The first person who gets paid is a secured debenture, the secured loan stock holder. The next person who gets paid is a liquidator, and indeed the liquidator, you run round, pay yourself, and run back and sit down again. So that's the second person. The third person who gets paid is the unsecured payables. That is things like suppliers, bank overdrafts, etc. Depends on the arrangement, of course, with the bank. But let's say suppliers, unsecured payables. The person who gets paid next is a preference shareholder. That is to say, shareholders who get their money back in preference to ordinary shareholders or equity shareholders. So you have preference shareholders, and then you have the ordinary shareholders. The ordinary shareholders, of course, have with them all the reserves of the company. So they run the company. The directors represent the ordinary shareholders. And of course, if they've made a mess of the company and the company's in trouble, it is right that they're paid last. So that if there isn't enough money to go around because of what they've done through their representatives called the directors, then they ought to bear the burden of the money not being enough. There's some justice in that somehow, I think. So let's run through that again. The secured debenture, the liquidator, the unsecured payable, then the preference, then the ordinary. The word preference in preference to, before the ordinary. Very simple material. However, let's march on to the next big statement. This is, of course, the statement of comprehensive income. Statement of comprehensive income, then, for the year ended 31st of December 2007, also known as the income statement. So I might just say IS, income statement, revenue. There are some notes, of course, for cost of sales, etc. So what I'm going to have to ask you to do is to put these things in brackets. So that comes to 197. The 38 and the 37 also in brackets. That comes to 120. Put the 8,000 in brackets and the 53,000 in brackets, then it makes a bit more sense. So let's see if we can improve this handout a bit. And this is taken away. I didn't write the material, even though generally it's very, very good indeed. Just the odd thing we can improve. Interest. All right, so that makes sense. Revenue, cost of sales, gross profit. Remember, in times gone by, we've done a single company, a single trader's accounts. Here we look at a limited company type situation. So the format is important, and little bits of it, of course, get examined. Profit before tax, income tax, profit for the period, etc. So that's the income statement. Nothing much for me to report. Learn it by heart, though, please, as indeed you must, the statement of financial position. Then we come to this famous SOCIE, S-O-C-I-E, statement of changes in equity for the year ended. It's always for the year. So as you imagine, there'll be an opening balance, 100,000, etc. Left to right added up. You find you have a total. Profit for the period, let's say, is 59,800 from the income statement upstairs. I'm sure it's up there somewhere. Indeed, look at that. This figure is here, and that, of course, is the total figure. The excess depreciation I'll come to in a minute, very, very rare at this level. It's much more at the next level up. Even there it's fairly rare, especially these days. And then you have the dividend paid. This excess depreciation is 2,000. Dividend paid, of course, never forget that the income statement never shows the dividend paid, okay? Here, never in income statement. I mean, nowadays never. Used to be the case. It used to be deducted in the income statement. I suppose the reason for that is if you don't have enough profit for the year, here we have 59,000, that's okay. It covers the 30,000 dividend. But let's say the 59,000 isn't as big. The shareholders can get the 30,000 out of the profits brought forward from previous years, you see, that had not been distributed as a dividend in those years. Because remember, the company must have enough cash to be able to pay the dividend. So the 30,000 is deducted in the SOCIE, rather than in the income statement. That's quite an important point. The IAS insists on it, and of course the Companies Acts, if it's under the jurisdiction of the Companies Act 2006, etc. So do be careful of that. So the dividend must be here, never in the income statement. What is this excess depreciation? You notice here that it's taken out of the revaluation reserve and pushed into the retained earnings, so nothing turns up in the total column. It has something to do with how much can be distributed as a dividend. Now, it's one of those very, very advanced points which I think has a very, very slight chance of coming up, probably will not come up. But let me explain it out of interest anyway. Basically, when you provide depreciation under IAS 16 and you've revalued your building, the depreciation, because of the revalued amount, will be higher. Now, that higher depreciation is based on the revalued amount, obviously. The depreciation, had it been based on cost, would have been lower. So you notice there's a little bit of excess depreciation. What the company lawyers allow you to do, the Companies Act people allow you to do, is to actually distribute that extra amount, the excess depreciation, even though it's charged to the income statement. So the income statement profit is lower at 59,800 because there was some extra depreciation charge. So don't forget, depreciation based on cost is so much. Depreciation based on the revalued amount is much more. The excess depreciation is supposed to be added back to profit, which is what is being done in the SOSI, and it can be distributed as a dividend. One of those odd points in the Companies Act. As I say, it's very advanced, unlikely to come up for us, but just nice to know on a practical level. So I find it's very debatable, very controversial type of item because, of course, what you are doing is taking something out of your revaluation reserve, even though you haven't sold the asset, and transferring it into a realized reserve, in other words, that you can distribute as a dividend. So you're not allowed to put that into your income statement, but you are supposed to put it through your SOSI. But enough of that. If it has a very small chance of coming up, I do not want to waste your time. So let's move on to the next page as we pick up a few more ideas, or shall we say, beyond the SOSI, beyond the statement of changes in equity. A limited company must file their statutory accounts with Companies House or wherever it might be in a particular country. A full set of statutory accounts will include a statement of comprehensive income, which is the IS, the SOSI, the SFP, and of course the cash flow statement. These statements are supported by notes explaining the balances. That's what those notes were doing earlier, those numbers that we saw. One of the key differences between a company and a sole trader is that a company is classed as a separate legal entity. You see, there are legal cases that prove that, as I'm sure you'll come across when you do your F4. This means that a company is deemed to be a person in its own right. Therefore, a company can sue individuals. It can also be sued. Interesting. The name limited company comes from the fact that the shareholders have a limited liability, as I was saying as we started this little session. So let's say that shareholders have a limited liability. In other words, their liability is restricted to the amount they have paid for their shares. So if they've paid $150,000 and the company goes into liquidation and there's no money for them, that's what they will lose. So there is some restriction anyway. If they've decided to not take dividends out and leave it in the company and reinvest it, and let's say that is also lost, well, that is the cost that they have to bear because they own the company and the company's gone into liquidation. But they get paid last, never forget that. Profits of a company are distributed by way of dividend payments. These payments are at the director's discretion. Now, do be careful of that. There are two types of shares, of course. You have the preference shares and ordinary shares. Preference, by definition, get paid first. Ordinary, of course, get paid later. So let's have a little look at our question called freedom. Example 1, Freedom Limited has 100,000 ordinary shares in issue. The nominal value, par value, is $1, and the directors decide to pay a dividend of 75 cents per share. Interesting, quite a generous dividend. So the nominal or par value is $1, and they've decided to pay a dividend of 75 cents. If this is the case, the company would pay 75,000, 100,000 times 75 cents in dividends, and that's the ordinary shares. The preference shares, this type of share is known as non-equity and gets a fixed return, just highlight that word, fixed return, on the value of the share. Preference shareholders will receive their dividend every year, providing the company has a bit of money distributable profit. Ordinary shareholders will receive a dividend if the directors so decide. And obviously the directors first propose it and the shareholders approve it. Don't forget the directors have plenty of ordinary shares themselves, so if they are going to push it through, they will benefit as well, which is fair enough. They work hard for the company and are responsible for the creation of the dividend in the first place and the profit. Now, just one or two things. The word preference, rather like I was showing you earlier, the preference shareholder stands a bit higher up the queue than the ordinary shareholder. So the preference shareholder gets paid their capital first if the company is in trouble, and only then does the ordinary shareholder get paid. Similarly, of course, when it comes to dividends, they get paid first, and then comes the ordinary shareholder. Now, if the preference dividend are paid, and there isn't enough money to pay the ordinary shareholders get nothing. So it depends on what the directors wish to pay. But the preference, by definition, are in preference to the ordinaries. So they must get paid first. Now, there are two types of preference shares. One is called redeemable and one is called irredeemable. If I assume it's irredeemable at this F3 level, then of course their dividend will be paid and they will be shown, the preference shares will be shown somewhere near the ordinary share capital just below in the SFP. If you assume they're redeemable, then the preference dividend becomes like a finance cost and is charged in the income statement. So it depends really on how you want to take it. At different levels is viewed differently, F7, F3, etc. So the simple truth is the preference shares are paid first in a liquidation, repaid, before the ordinary shares. The ordinary shares, of course, are repaid, the reserves as well. And then similarly, when it comes to dividends, the preference dividend is paid first, and only then, if there's money, will the ordinary dividend be paid. Okay? So it's quite a straightforward idea, but the preference must be paid before the ordinary dividend can be paid. That's the message of that section of that page. So that's your little example 1 done. Let's march on, therefore, to example 2. The following information relates to Voyager Limited. Year ended 31st December 2007. Share capital 25 cents. Now, careful, careful, careful. This is one of the oldest tricks the examiner will use. If the share capital is 25 cents per share and the total is 100,000 share capital, would you agree there are how many shares? You're right, 400,000. 400,000 shares in issue. Preference shares, I'm going to assume £1 each, $1 each. So obviously there's 50,000 shares. The directors proposed an ordinary dividend of 75 cents per share. So if you take your ordinary dividend of 75 cents, you multiply by 400,000, and that of course is 300,000 is the total ordinary dividend. So that's the ordinary dividend. And as far as the preference dividend is concerned, because it's a 6% type of dividend, 6% of 50,000 is clearly 3,000. So let me ask you to think about that for a second before we look at the solution. So when you're ready, let's have a look at the solution. The ordinary shares, we were saying 300,000, which is obviously 400,000 multiplied by 75 cents. We got the 400,000 by being extremely careful with the par value per share. So it's almost like I'm doing a fraction. 100,000 is the ordinary share capital, or OSC, divided by 0.25. So the answer, of course, is 4 times that to come to this. So multiplied by the 75 cents dividend gives us 300,000. The preference shares, of course, are 6%, and so you have 3,000. Now here comes some interesting points. I just wanted to stretch your mind, if I may. What comes up in the exam? Surely that's the reason why we're here. The 3,000, let's say if half the preference dividend is paid, which is say 1,500, the second half must be accrued. That is to say, it needs to be paid. So what goes into the SOSI? Obviously the whole year's dividend. If in fact this is an irredeemable preference share capital. So what goes to the SOSI alongside the ordinary dividend? If half has been paid, the amount that goes into the SOSI, of course, is the full year, which is, of course, 3,000. But what goes to the SFP is what hasn't been paid. That is to say, it is accrued and therefore payable. So you need to take a view as to what you're going to be doing with the preference dividend. If I can make a small assumption, assuming they are not redeemable, irredeemable, preference share capital, PSC, irredeemable, then obviously if half the preference dividend is paid, say 1,500, what goes to the SFP as a current liability must be the other half. The other half, i.e. $1,500. So that's the amount that goes to the current liability. But what goes to the SOSI, on the grounds that you're not allowed to show these things if it's irredeemable in the income statement, what goes to SOSI, of course, is the full 3,000, because we do things on the accruals basis of accounting, not the cash basis, as we were doing in a recent session. So if you assume that it's irredeemable and therefore the dividend goes to the SOSI, that's how you deal with it. If you assume it's redeemable and the dividend doesn't go to the SOSI but it goes directly to the income statement as finance cost, then of course the same principles apply. If half of it has been paid, the half that has been paid goes out of the cash book, obviously, and the second half that hasn't been paid must be shown as a current liability in the SFP balance sheet, the current liability. But of course the total amount of 2 halves of the 1,500 each, coming to 3,000, that must go to the income statement as a finance cost. Very simple rule indeed, but it does come up regularly. Do be careful. Another thing that comes up from time to time is Section 610 of the Companies Act 2006. That is, of course, the share premium account, or whatever section you want to remember. So let me just put in the most commonly quoted section, 610 of the Companies Act 2006. If a company issues shares after the initial incorporation, it is unlikely they will issue them at a nominal or par value. I'm now moving away from preference shares and ordinary shares and that kind of thing. I'm now looking at share premiums. If a company issues shares after the initial incorporation, it is unlikely they will issue them at a nominal or par value. As the company has established itself, the net worth of the company would decrease, or would increase, I beg your pardon, and this would be reflected in the share price. So what we're saying is when the shares were first issued, they probably were issued at $1 each or 25 cents, or whatever it might be. But let's say $1. But if many years down the line the company decides to issue some more shares, clearly they will not issue them at some old nominal value when they were first issued, when the company was brand new and had no real value. they will issue them at many times the price. And that excess value, the difference between the issue price and the par or nominal value, goes to share premium. And that is what Section 610 governs, or the rules govern. That's good enough. So here we are, example number 3. So we moved on from examples 1 and 2 into example 3. The following relates to radiance, capital and reserves. Share premium, $1, 200,000. How many shares is that then? You're right, 200,000 shares. So I don't need to divide by anything special like 25 cents because, of course, it's $1. So 200,000 share capital at $1 is 200,000 shares. Retained earnings is 233, whatever figure. And then you have the revaluation reserve of 125,000. Say the market value price per share is about 385. Just an example there. Would you agree the excess value, if I can just break that down, $1 of that is what's known as par value, par or nominal value. The leftover bit, 285, is obviously the share premium. The share premium. And the directors wish to issue a further 50,000 shares for cash injection purposes. The double entry, traditionally you show your debits first. Doesn't matter too much if you're doing a computer-based exam, but just nice convention. The bank, obviously, your bank account, your asset goes up. Assets are debits. I'm going to do that first. Debit bank, 50,000 times 385, 182,500. So that's the debit. And the credit goes to share capital, you notice, limited to $1. So that is the par value. See? And the excess money, the extra money, goes to the share premium. So the Section 610, etc., insists that the par value, the nominal value, goes to the share capital, and the extra value goes to the share premium. Be careful of that. And that's how we got the 142.5, multiplying 50,000 by 285. Quite straightforward, really. The capital and reserves would now be as follows. So I might highlight the word now. Share capital, 250,000, of course, because you remember previously the figure if you go back, the original share capital was 200 plus this 100 makes it 250. The share premium, of course, is 142.5. What that is quite simply the 142,500 we had upstairs, because earlier there was no share capital, there was no share premium, beg your pardon. So from 0 it's jumped up to all the new issue, you see, all from the new issue. 233, 456, no change. And this also has no change. The revaluation reserve. Obviously the bank balance goes up by the new funds received, 192.5. Also, the bank account will go up by the new funds received, i.e. 192.5, but of course is not shown in this little solution. So very, very easy material indeed for you to cover. However, let's march on to some new things. We have ahead of us something on capital reserves and such like, so let's see if we can pick something up. Capital reserves. The share premium account is classed as a capital reserve. That means it can't be used to pay out dividends. Cannot be used to pay out dividends. It's a capital reserve, meaning it has a permanent role to play. It's permanently in the accounts. It's a bit like share capital, I suppose. You can't use share capital to pay dividends, for example. The use of capital reserves is very limited, very restricted. The key use of the reserve would be to finance a bonus issue of shares. I see. What does bonus mean? It has a feeling of free, has it not? Being free. This is when the directors distribute free shares to existing shareholders. Very, very, very important indeed. Free shares to existing shareholders only. I might add the word only. So you can't give bonus shares to new shareholders. They have to pay the full price. But basically what's happening is something like this. Let's say in years gone by, when you first issued the shares to me, I gave you $1 and that was fine. A few years later, you felt that you wanted to raise some more money, 5 years later, so you issued the shares, but this time because the company's net assets worth had gone up, you issued them at $3.85 instead of $1, $3.85. So the extra $2.85 you're going to put to one side called the share premium account. Now notice, remember, me and my friends, all of us representing your shareholders, you're the company, the directors, etc. We are people outside. Let's say you're the company as a special personality on your own, and all the shareholders are on this side. So you're the company, we are shareholders. Because we've given you $3.85, and $2.85 of that is the share premium, which we've kept to one side in our name, we don't get dividends or anything like that based on the share premium. We only get dividends based on the ordinary shares. So what you're saying is today, 5 years later, or maybe 2, 3 years on, so you started, 5 years later you issued shares at a premium. A couple of years later, what you're saying to me is, hey, thanks for your loyalty. The excess money that you gave us a couple of years ago, remember the $2.85 per share, we're now going to transfer them from share premium into share capital. We can't give you a dividend because we're not allowed to give dividends out of share premium. But what we can do is to say thank you for your loyalty. So we're going to debit the share premium account and credit the share capital account. So that excess value is what we need to do as we pick up this little idea. So as usual, the debit goes first, debit share premium, and of course credit share capital. Show the debit first traditionally. So would you agree that if you start crediting the share capital, you have more share capital, SC, and if you debit your share premium, that reduces the share premium, see? So it's like you're taking money out of the share premium account and giving it to the shareholders as real shares, and just a way of thanking me for my loyalty, me and my other shareholders. So capital reserve, quite easy to understand how that works. The most famous capital reserve, of course, is the share premium account. Just review the last few pages, please. Just take some time getting these very key points in place, things like the preference shares, the ordinary shares, etc. So let's resume. Dividends. As we have seen previously in this very chapter, dividend payments are used to distribute profit to shareholders. In order that a dividend can be paid, the company must have reserves that are distributable. They cannot be paid out of any reserve that is not realized. For example, a revaluation reserve is outlawed. You can't do that. Final dividends are paid after the year end, once the financial statements have been completed and the directors have decided the dividend amount. So clearly there's plenty of doubt about whether any dividend will be paid, especially these days where times are a bit harder, economic downturn, many countries of the world. An interim dividend can also be paid midway through the year, you see, hence the word interim, partway through the year. So we have here some ordinary share capital. Let me assume that these are odd or ordinary. share capital, also known as OSC, ordinary share capital. They're 50-cent shares, $200,000. So how many shares are there? You're right, 400,000. And these are ordinary shares. 400,000. The preference shares, so those ordinary shares are those figures there. But the preference shares are quite different. They are meant to be 10%. Now I better be careful and call those preference share capital to give it its proper title, PSC. And that's meant to be 25,000 in total. An interim dividend of 8 cents per share was paid during the year, and the directors would like to propose a final dividend of 9 cents per share. Final dividend of 9 cents per share. So, the total dividend paid, I suppose, is 9 and 8, 17. 8 has been paid already, 9 is going to be paid. It then says, calculate the total dividend payable for the year ended. So please be careful as you move on to having a look at this answer. So I'm going to turn to the next page as we have a look at a solution. So it saves writing it all down. See, I'm releasing a bit of time to think about these things as well. So here we have it. The ordinary shares, if you remember, were 400,000 shares in issue. No problem with that. Because they're $0.50 per share, so if you have 200,000 share capital, $0.50 each means 400,000 actual shares, of course. Interim dividend is 400,000 multiplied by 8 cents, 32,000. The final, of course, is 400 times 9 cents, which is 36,000. So altogether, if you do a quick mental check, that's 68,000, which is obviously 17 cents multiplied by 400. So that makes sense. It's a bit of sense. So 68,000 is the total there. The preference shares, of course, we decided were 10 cents or 10%. And if they're $1 shares, assuming they're $1 shares, assuming they're $1 each, the 10% of 25,000 is 2,500. So if you add it all up, it's 70,500. Then you have your taxation. All companies have to pay tax on the taxable profits. All companies have to pay tax on taxable profits. So I hope that preference share capital and that sort of issue makes a bit of sense to you. I'm now moving away from dividends and share premium and so on. So remember what happens here. It's quite simple. When the company is first formed, they can issue shares at whatever they like, let's say $1 a share. 5 years down the line, when they issue shares again to raise more money, they're entitled to issue it at more than the nominal value, maybe at $3.85. The excess $2.85, the company keeps to one side for a few years, doesn't pay the shareholder any dividends based on that or out of that. So they don't actually qualify as shares. It's just frozen as a share premium account, which is why you need sections in Companies Act and things to control that, because it's a large sum of money many times, maybe many times the share capital size as well. Now what happens a few years down the road, say 2 years after they've issued the shares at a premium, the company rewards the shareholder for loyalty by offering them some bonus shares, free shares. In other words, existing shareholders get some shares free. For example, they might say, I'll give you 1 share free for every 4 shares you currently hold, in which case you would find that the share capital goes up by about a quarter. So if you have 4 shares, you get 1 more share. So it's now bigger than it was by about 25%. And of course, the shareholder is extremely grateful because now, of course, I qualify for some dividends. I have some voting rights, etc., because of these new shares. That's the way it works. Very, very straightforward. Now, let's spend a couple of minutes on tax. Who likes paying tax? But we have to. Certainly companies are charged huge amounts of tax. All companies have to pay tax on the taxable profits. The tax charge is normally estimated at the end of the financial year and charged to the Statement of Comprehensive Income, which is the IS income statement, and is paid in the following year. So at the end of every year, the company will provide, let's say at the end of this year, it will provide some tax, which is paid in the new year, a few months later. Now, clearly, when the amount is set up as a liability, you have to debit the income statement with the tax, which is basically what is being done here. And the credit, of course, goes to the SFP as a current liability. And then subsequently, when the current liability is actually paid, there will be nothing left in the account. Though sometimes what happens is companies under-provide by mistake. They're doing their best, but after arguing the situation with the tax authorities, they might find that even though they've provided $100,000, the tax authorities might ask for $105,000. So what you do in the new year is you just charge the remaining $5,000 as an adjustment. Or indeed, if you've provided, say, $100,000 and it turns out to be just $98,000, you've got an over provision of $2,000. But that comes up more at F7. Don't have to worry about it for this level. At this level, what we do is we provide tax at the end of one year and we pay it in the next year to clear the arrears. So the current liability has gone. Just one other thing I thought I'd mention before we close our limited company coverage. A little later on, I'll pick up a comprehensive question to show you how limited company accounts really work. But before we do that, I thought I'd give you a couple of words on something called a rights issue. So maybe lower down the page, I might offer you a completely different concept altogether. So I'll draw a line. And I'll just say, what is a rights issue? Quite simply, it's something that the company gives to existing shareholders, gives them the right to acquire additional shares at below the full price, you see, but it's above free. Free, of course, is bonus. So if the full price, let's say at the time the company issues shares, let's say $3.85 for the sake of argument, and they're giving them rights shares. What they're saying to existing shareholders, you can apply for some additional shares, let's say 1 share for every 5 you hold or whatever it might be, but for this additional share you have to pay us something, not $3.85, the full price, but say $2. So it's below the full price, $3.85, but it's above free, which is of course the bonus share, the zero value. So that's all it means, the rights issue concept. So let us just play around with some numbers. Say, might write in a slightly darker ink, say full market price is $3.85, but rights issue price is, say, $2. Below full, but above free or bonus. Below full but above free. So $2 is somewhere between $3.85 and 0, of course. It'll be above the par value usually. So what the company will do in these circumstances is just say, for the sake of argument, they are issuing, what shall we say, perhaps 1 for 5. And if there are, for the sake of argument, say 400,000 shares in issue, 1 for 5 would equal 400,000 400,000 divide by 5 multiplied by 1, say 80,000, and these shares, if they issued at $2, the $1 goes to share capital, the other bit goes to share premium. So this one, if it's issued at, say, $2, like we were saying, it's the way it will be split, 8 2s, 160,000 is the money raised. What I'm going to say is 80,000 multiplied by the $1 par value. In fact, I think what I shall do is make the par value, say, 50 cents for the sake of argument, just to make it a little bit easier to see. So I'll make the par value, say, 50 cents. So 8 5s are 40,000. That goes to the ordinary share capital in proper dollars form. And then the other bit that makes it up to $2, which must be $1.50, that goes, of course, to the share premium account, SP. And so if the company is raising 160, 1.50 I should say, multiplied by 80 is 120,000, and that is the extent to which it goes to the share premium account in dollars. Okay, so all these are dollars, of course. So what we're saying is the amount that goes to the share capital account is the par value, 50 cents or whatever per share. The amount that goes to the share premium is anything above 50 cents going up to $2, $1.50 that is, multiplied by the number of shares. So don't forget, a bonus issue is taken out of the share premium account and given to shareholders free to thank them for their loyalty. And as a result, the company's share capital goes up, the share premium goes down, it might even all be used up. And of course, from the shareholders' point of view, they now have more shares, more dividends, more votes, etc. They feel they're participating a bit more. That's a bonus issue. Okay, so the shares were issued at a premium, now they're being rewarded by being given bonus or free shares. Now, quite apart from bonus shares, we have this other concept of rights issues. Those are by right given to existing shareholders, but they have to contribute something. So the company does raise some money. And the reason why rights issues are used to raise money is the people who are shareholders probably like this company anyway. The very fact that they're shareholders means they have some faith in the company, the directors, etc. So because they like the company and its future prospects, they're likely to invest. So if the company wants to raise some money, they tend to try the rights issue path. There are also some savings and costs as well. But the biggest thing is the people they're addressing are likely to say yes and actually contribute something. But what does the company do with the money they receive? Quite simply, if the par value is 50 cents, that goes to the share capital account. But the excess value between, say, the par value and the rights issue price, which is $2, but the full price may be $3.85, it's the $2 I'm concerned about. The number of shares that are issued, let's say if there are 400,000 shares for the sake of argument, and it's 1 for 5, the rights issue, the rate at which you're giving the rights issue, 1 for 5, what I'm going to say is there are 80,000 new shares issued, and because 50 cents, 80,000 times 50 cents, 40,000 goes to the share capital account, the 80,000 shares multiplied by $1.50, which is 120,000 shares, that goes to the share premium account. And who knows, in years to come, that share premium may be used to issue bonus shares. And so the cycle continues. that's the end of my introduction to limited company accounts, one of the great topics of our syllabus, one of the most useful in practice for any qualified ACCA.